Hi, Gabriel Josiah here. Okay, today we'll be looking at our discussion on profitability ratios. We'll be looking at operating profit margin. In the last class, we looked at gross profit margin. So today we'll be continuing on that discourse with operating profit margin. So let me share my screen quickly and let's delve fast into discussion for the day. Okay, so I believe you can see my screen. All right, operating profit margin, it's our discussion for today. So what is operating profit margin? You can describe it as a key profitability ratio that measures the percentage of revenue left after covering all operating expenses. So it's a percentage of revenue after we've deducted our indirect costs that has to do with administration, operating, distribution expenses. They are not directly linked. We call them variable costs. They are indirect costs. So after deducting them, you have your operating profit margin. Okay, so this is expressed as a ratio, but the operating profit itself, it's after you deducted your indirect cost. This reflects the efficiency of a company's core operations and how well it manages its operating costs relative to revenue. So the operating profit margin depicts the efficiency. It tries to show how well management are working assiduously to control operating costs in relation to revenue. Now, the meaning is that OPM indicates how much profit a company makes from its core business operations before interest and taxes relative to its revenue. So before any external deductions, the internal expenses are first considered, which is known as our earnings before interest and taxes, to calculate the operating profit margin. It also provides insights into the company's operational efficiency, showing how well it can generate profits from its regular business activity. So not irregular or inorganic income, but organic income and the expenses that has to do with direct or indirect impact on the core operations of the business. So this is the formula. It's calculated by operating profit, which is earnings before interest and tax, divided by revenue expressed as a percentage of 100. Okay, so with this formula, let's continue with our example, which is Sharobutu and Sons Nigerian PLC. We'll be using this example to buttress or describe practically how to calculate these ratios. So operating profit margin is not an exception. Now let's calculate the operating profit margin with this company, and we take the first year, which is as at 31st December 2020. So where's our operating profit? Now let's start with the bottom line. Now the bottom line has to do with our profit after tax. So let's pick that. So we add back to arrive at our earnings before interest and tax. So let's pick our profit after tax. I cut instead of copy. Okay, so let's go to our Excel sheet we'll be using and add back let's start with our profit after tax. Then we go and pick other items, then add them back. So let's go with our tax expense. We add it back to our profit. So we want to walk back to arrive at our earnings before interest and tax. So after adding back our tax expense, we deduct the finance income. Okay, so this is a deduction since it's income. Then we also go back and we add back our finance cost. So add back our finance cost, which has to do with 20,000. This is added back, so remove the minus sign. Okay, so this is deducted and we arrive at our earnings before interest and tax. So this is our operating profit, which is our earnings before interest. Let me just abbreviate it: earnings before interest and taxes. So let's look at the question again. You can see this is our earnings before interest and tax, which is 95 million naira. Okay, so having done that, let's now get our revenue figure. So our revenue figure is starting from the income statement. Let's pick that graphically, and that is the figure. So it is our revenue, and we have that as 1.2 billion naira. So now, calculating our operating profit margin, we have it as operating profit divided by our revenue, which is expressed as a percentage. And we have it as a percentage of 8%. So for the year 2020, only for Shagobutu Nigeria Limited, we have it as 8% for year 2020, a positive figure, which is fair enough. At least it's positive, even though it's low, it's still a positive beginning based on the financial information provided to us. So you could see we buttressed this formula with a practical scenario, a practical calculation, and I think it's fairly simple. So don't forget to add back the items before interest and taxes, or your taxes, your interest, if you have finance income, you deduct it to arrive at your earnings before interest and taxes. So the bottom line, which is the profit after tax, should be started from. It's good you start from your bottom line. It will help you capture the items to add and the ones to deduct. This is very important. Okay, so your earnings before interest and taxes is calculated by operating expenses, which I've spoken to previously as indirect expenses: wages, rent, utilities. Cost of goods sold are direct expenses, which has to do with our items we incurred to bring the product or service to the consumer. But the operating expenses are indirect expenses that are incurred, which are also known as variable costs. Also, the revenue is the income generated by the company's sales of the goods or services. What are the implications? A higher operating profit margin indicates that a company is efficient at controlling its operating expenses, leading to more profits from its core activities. Very important. This can imply strong operational management and higher profitability. So management is intentional and very, very hardworking in terms of ensuring expenses are controlled at this point. So I may call it the second level of expenses after the direct costs that has to do with cost of sales. So this may be the second level, and management has to be careful, and it shows strong operational management, which culminates in higher profitability. While conversely, a lower operating profit margin shows the operating costs are out of control, consuming a large portion of revenue. And this also signals or culminates in inefficiencies or a need to reassess their cost management strategies or their control procedures. This is important. Now, what is the cost effect? The cost of a higher operating profit margin is strong sales performance, effective cost control, that is managing labor, materials, and overheads, which are the indirect costs I spoke about. So economics of scale, where large production volume reduced per unit operating cost, also streamlines operations and reduce waste or inefficiencies. These are items or factors, metrics that speaks to a very high operating profit margin. While on the other side, a higher operating cost such as rising labor, materials, expenses decreases the revenue and affects the operating profit margin negatively. It culminates in inefficiencies in production, logistics, admin expenses, pricing strategies that do not sufficiently cover operating expenses. So what are the effects? Higher operating profit margin increases profitability from core operations, also provide more cash flow to meet debt repayment, also helps to expand the business, and also provide shareholders dividends. This is very important. It also improves investors' confidence as it signals strong financial health and operational management. This is very important in business. While on the other hand, a lower operating profit margin leaves less capital for reinvestment or plowing back into the business. It also does not provide availability of funds for debt management and other growth and expansion initiatives. It may raise concerns among investors about the company's ability or management's competence to manage costs or generate sustainable profit. So, by a way of conclusion, you will observe that the OPM is a critical measure of a company's operational performance and efficiency. A strong margin suggests efficient cost management and a profitable core business metric, while a declining margin signals the need for improvement in managing operating or indirect expenses or costs. So regularly monitoring this ratio helps businesses maintain profitability and attract investors. This is very important. So having looked at the operating profit margin, it helps understand from core operations how profit can be generated, and where you have a positive percentage, this should be harnessed, grown, and assiduously worked on by management to always report a positive operating profit. This shows competence and the well managed business. The way the business is managed shows that operating expenses are brought under control, and also helps show management is doing their best to ensure the company is on a positive lane. All right, thank you very much, and that will be the end of this our short discourse on operating profit margin. Okay, let me know what you think about this profitability ratio. Post your thoughts in the comment section, and I'll attend to them. Any observations about this ratio, and also don't forget to like, share, and subscribe. I'll see you in the next class. Until then, bye for now.